we discuss about how to solve the numericals of cash flow and fund flow. So, as we discussed last session, cash flow and fund flow are the two integral parts which normally talks an important part of a financial statements, which gives an idea how the funds are coming in or how the funds are spent. As I said, cash flow is essential part as per the accounting standards and disclosures, whereas fund flow is a complementary part which is just prepared to understand flow of money for analysis purpose. So cash flow is a compulsory and fund flow is an internal. There's a fixed format for the cash flow, but for the fund flow, there is no fixed format. Cash flow is prepared to see where the funds are moving in cash and nearby cash, whereas fund flow is prepared to understand flow of money for working capital. So in case of fund flow statement, it is an internal requirement what we are providing with. So let's talk in more detail. Of fund flow or cash flow, we are always dealing with numbers. Now, what the figures we are dealing with? We are talking about inventory, we are talking about data, we are talking about any other things. But in cash flow, we are adding all the parts and together. So let's talk about how to solve cash flow and fund flow statements. So let's understand the basics. Fund flow statement is a source and application of funds which shows how an organization is managing their internal and external assets and liabilities so that operation or business are continued. Now, when I say operations, it talks about a production cycle. And when I'm arranging the funds for a production cycle, it is called as working capital. Normally, fund flow statement is for shorter duration. For long-term fund investments, the decision taken are adjusted against profit and loss. But in fund flow statement, my core interest is how I'm organizing funds for my working capital. In fund flow, I'm not disclosing my financial portion, but I'm just analyzing how my funds are sponsoring my production activity and generating revenue for myself. And what is the cash flow? Cash flow is a bigger quantity where operational part, investment part, and finance, these three things are combining. But my core interest in cash flow is to check how cash is coming in, that is how money is coming in and how money is going out. So basic difference is fund flow talks about more working capital and cash flow talks about income and expenses. Now this is a comparative statement of fund flow and cash flow. Fund flow focus on working capital and cash flow focus on actual cash flow, that is incoming and outgoing. The fund flow is a border because this includes cash plus non-cash expenses, whereas in cash flow statement, only cash expenses or cash transactions are included. Then the format of fund flow has two sides, source and application, but it can be changed as per the requirement of analysis. Since fund flow is an integral part and it is made for integral decision making, there is no fixed format or standard which is there. There are guidelines, but no fixed format.
In case of cash flow statement, it consists operating, investment, and financing sections and divided into two columns, inflow and outflow. When a fund flow statement is not balanced, it is called as funds from operation or funds for operation. If it is extra, that is suppose if income side is more and expense side is less, then it is called as a funds for operations. But in cash flow statement, whatever the plus and minus points, they are transferred to either profit and loss account and either to the cash accounts. Both the statements are parallel to each other. The cash flow statement showing the flow of cash and fund flow statement showing movement of working capital. Because fund flow statement is a cash plus non-cash, it is a broader sense, but it is not mandatory. Normally, as an annexure of balance sheet, you will find mostly cash statement is there. Giving fund flow statement is not obligatory for any financial statement. So, fund flow statement captures working capital, credit transaction, non-cash items, and it mostly focus on my financial position. It focus on whether I'm in good position to start a new project, whether I'm in good position to go with new changes or something. So fund flow statement gives an idea what is in my pocket that I can count about to take a decision for my future needs. Where cash flow statement only records receive 10 rupees, spend 5 rupees. Now the amount I said is the individual basis. So if business received petty cash of 10 lakhs and spent 5 lakhs, that amount of cash is recorded in cash flow. The importance of cash flow is that talks about liquidity of any business, whereas fund flow talks about comparative statement showing financial position apart from balance sheet. So in fund flow, I understand flow of funds and what is exact my financial position of cash and non-cash. But in cash flow, I talk about what is the liquidity position I'm having and how I'm enjoying the thing. Now let's talk about the formats. The fund flow statement has statement changes in working capital, where I'll be dealing with working capital components like current assets and current liabilities. The current assets are those assets which are always changing as per the flow of their incoming and application, whereas current liabilities are those liabilities which are always changing. So when I calculate difference between current assets and current liabilities, I get the working capital. And when for this working capital, I try to find out source, I get this amount from statement showing changes in working capital. Suppose my non-cash items like depreciation provisions are there. Normally it is called expenses. But in case of fund flow statement, even though depreciation is expenses, it is indirect saving I'm having. So it is adjusted in operations. Similarly, when outflow is there and appreciation of asset is there, it is always deducted as expenses. Hence, when I calculating statement showing changes in working capital, I'll find out year one, year two comparison. Suppose year one, my current assets are 10 and year two, my current assets 20. So if asset increase from 10 to 20, it means there is appreciation in assets. So it is a 20 minus 10, 10 asset is appreciated. But suppose my asset is 20. Um, okay, just 2 minutes. If my asset is 20 and my liability is 10, then that working capital is 10 for the first year. Next year, if my asset is 30 and working liability is 10, then my working capital is 20. So this is second method that each year I will calculate working capital and then I deduct it. Or each year I'll calculate difference between asset and liability, and then I clear it. So let me show you by illustration. So, for example, this is year one, this is year two. If I say current assets and current liability, year one current asset is 100, year two current asset is 125, year one current liability is 75, and year two current liability is 100. Now, there are two ways. This is year one figure, this is year two figure. So if year one, if I calculate working capital, 100 minus 75, it is 25. And if I calculate second year, 125 minus 100, it is 25. So my change 25 minus 25 will be 0. Now luckily we got the same figures. In fund flow, I can do this one way, or suppose if I'm calculating alternate method, then year 2 125 minus year 100, so difference is 25. Year 2 liability was 100 and year 1 it is 75. Now in case of asset increases, it is shown as a positive. But when liability increases, it is shown as negative. Because when my liability increases, it means I'm not paid it earlier year. So change in asset is always shown positive, whereas change in liability, it is shown as negative. So 100, it is gone first from 75, so it is minus 25. And if I make a total, it becomes 100. Let's give it other way. Suppose this is year one and this is year two. My current asset and current liability. If my asset for year one is 100, for second year it is 200. In case second, my liability for the first year is 50 and second year it is 75. Now again, if I want to find the working capital changes, so 100 is deducted from 200. What I get is 100, and from 50 I gone to 75, so minus 25. My change in working capital will be 75. If I check it other way, here my working capital will be 100 minus 50, it is 50, and here it is 125. So year two, my working capital is 125. Year one, it is 50. So if 125 minus 50, what I'll get answer is 50. So this is nothing but the statement showing changes in working capital. Now, let's move further. Cash flow is talking about operational activities. It has three parts. One is the operational, investment, and financing. It is basically talking about a financial position of organization. So when I say operation, it talks about cash from customers, payment to suppliers, salary, wages, taxes, and so on. Now, what are the expenses which are paid in a cash or in kind of cash? They are always recorded in cash flow. In investment activity, if I purchase something or sell something, then these activities, or if I acquire something or I dispose something, all this activity, or if I take a loan or I repay the loan, I take the shares, I make an investment for any reason, it may be operation, investment, or financing. If I'm spending money or I'm receiving money in terms of cash or near cash, it is recorded in cash flow statement. There are two methods how I can prepare the cash flow statement. One is a direct method and second is indirect method. In direct method, list of actual cash receipts and payments are categorized into received and paid, that is received from customers and paid to suppliers or employees and interest. Whereas the indirect method, what I'll do, I'll start adjusting net income against non-operating and working capital changes. So normally in your syllabus, we follow the second method, that is calculation of non-cash and changes in working capital. Because the first method, we are having a limited application in Indian accounting standard. Now let's talk about how we can solve the numericals for C. The first thing you need to do is identify the financial statement, find out what are the current assets are there, what are current liabilities are there, what are the accounting period is given, whether that is a prepaid, postpaid, whether they are not paid, outstanding, find out from balance sheet. Find out what is for year one, what is for year two, and if more than 1 year, find out each year separately. Then calculate the changes in assets, liability, and equity. Now, why asset, liability, and equity? Because if change in asset is there, for example, 100 asset 1 year and second year it is 200, it means I have purchased the asset. If I have purchased the asset, definitely my cash flow will be there. In reverse way, suppose asset is 100 for the second year and first year, sorry, asset is 100 for the first year and second year 50. It means from 100 to 50, my asset is declined. So when my asset is declined, it is simple meaning if more than 50%, if my asset is declined, it is assumed that my asset is sold. Because if my asset change from 100 to 98, it can be a depreciation. So marginal change in asset is recognized as a depreciation. But major change more than 10%, if not anything given, then I will assume as its sale or purchase of asset. So when sale and purchase of asset, it will be nothing but movement or changes in cash flow. Similarly, if my liability changes, it is also considered cash flow. In case of equity, it can be bonds, debentures, or any shares. If the number increases, it means I have issued new capital. Then I get money. So it's a inflow. In reverse way, when my capital reduces, then it indicates I have buyback my shares. And when I do buyback, I'm going to spend the money. When I'm spending money, it's outflow. After identifying the changes in asset, liability, equity, I have to find out cash and non-cash items. I have to divide between non-cash items and cash items because in cash flow, I'm not going to consider non-cash items. And in fund flow, I'm going to consider both the items. Now, there are certain adjustments which I need to cover. If if I am doing income statements, then cash and non-cash items are needed to add back. As I said, goodwill, depreciation, amortization, and return of assets are need to consider on judgmental value because when it's a goodwill, the change in goodwill can be recorded in fund flow. But since change in goodwill is a non-cash item, it is not recorded in a cash flow. Similarly, when I make a provision for depreciation. It's a non-cash item. It is shown in fund flow as adjustments, but in cash flow, since the flow of money is not there, it is not considered as expenses. If I get loss or profit from sale of any fixed asset, it is always claimed as a part of profit and loss account, and that profit and loss account is part of fund flow. But since profit or loss is not part of flow of money, it is not shown in cash flow statement. And most important, any interest on a loan, any dividend given, these are just an additional burden a business prepared or additional benefit business receives. In both the cases, these two income or expenses are only shown in fund flow. And if the amount is received or amount is paid, then only it is shown in cash flow. So these are the adjustments I need to remember while preparing fund flow and cash flow. Now this is the illustration. I'm not going more in detail about what is inventory, what is the data and prepaid expenses. So my opening balance, now when I say opening balance, it is means this is a closing balance of last year. And when I say closing balance, means this is the balance of current year. So in the initial period, my inventory was 50,000 and now it is 65,000. It means there is appreciation in the value of inventory. So when I deduct 65,000 minus 50,000, I'll get increase in 15,000. Similarly, for debtors, 55,000 minus 40,000, I get appreciation of 15,000. Whereas my prepaid expense is 5,000 and now it is 3,000. So when prepaid expenses means I have paid amount in advance. So if I paid the amount in advance, it is my asset. Now I paid the less amount at the end. That means it is less 2,000. Please remember, for assets, any plus or minus, it is having same effect. But for liability, it is exactly reverse. In case of asset, any addition to the amount, it is shown plus. And if any reduction in amount, it is shown as a negative. But in liability, if you see creditors for 30,000 and now they increase to 45,000. So it is change in 15,000. So in case of liability, I need to adjust amounts as a negative because increase in liability is not always a welcome sign. So my change in liability was total 17,000 and my change in asset is total 30 minus 2, 28,000. So 28,000 is change in assets, 17,000 is change in liability. So because this increases, even though it is showed plus, it is always considered negative. So 28,000 minus 17,000, what I get is working capital 11,000. So what we remember, current asset increase or decrease in the current liabilities, working capital, decrease in current asset and increase in current liability, decrease in working capital. So if assets are increasing, it's a favorable situation. But if liability is increasing, it is called unfavorable situation. And that's why we, when calculating changes in working capital, we need to calculate either 1 year, then minus second year, or we can calculate the parallel system. Now, let's talk about how to prepare. The first thing, when you're preparing working capital statement, you need to calculate opening and closing balance of working capital if it is available. How you calculate? You have to find out current assets, you have to find out current liabilities. When you find out current assets and current liabilities, it is your judgment to find out from a balance sheet what are the current assets and what are current liabilities. Then you have to calculate changes, that is increase or decrease. And after adjusting current asset minus current liabilities, you can find out change in working capital. And this change in working capital is shown as a fund flow statement. Now, let's prepare a fund flow statement. Fund flow statement has two columns. One, funds from operation, and second, application of funds. Now, funds from operation, sorry, source of funds and application of funds. Source of funds talk about how the funds are coming in, whereas application of funds, it will talk about how the money is moving out. So, funds from operation talks about adjusted profit, that is, if anything change in profit, it is shown. Secondly, thus it is called as issue of share capital. When I issue share capital, I am receiving money, it's source of funds. Sale of fixed asset, it is source of fund. Now, the most important is decrease in working capital. Now, what is decrease in working capital? Suppose earlier I required 100 rupees to operate my business. Now I require only 50 rupees. So instead of 100 rupees, if I require 50, it means I required less money. So when I required less money, it is means I have 50 rupees extra. Now that extra will be called as source of funds. In reverse way, current year I was required 50 rupees and next year I'm requiring 100 rupees. So when I required more money in next year, it means I have to arrange 50 rupees more. So when increase in working capital, it is shown as application of funds. And when decrease in working capital, it is shown as source of funds. Now what is application? Application involves payments what were done, or it is the reason why income is paid. It can be purchase of fixed asset, repayment of loan, reduction of any capital part, payments of dividend, payments of taxes, and so on. So whatever the payments I have done, because of which funds are going out, it's a fund flow statement. And whatever the reasons I'm getting the funds, cash or non-cash, it is a source of funds. Please remember, fund flow statement is tallied by way of increase or decrease in working capital. I shown both the thing here, for example, but in actual, it is only one. So when I'm preparing a fund flow statement, I'm preparing two documents. One, statement showing changes in working capital, and second, fund flow statement. If fund flow statement tally automatically, what is mean by automatically? I have to mention source and application of funds and whatever the balancing figure, either on debit side or credit side. If it is on debit side, it means my source of funds are more, then it is called as increase in working capital. Or if it is on credit side, that is the application side, then it is called as an increase in working capital. So that fund flow statement will be tallied by changes in working capital statement. And if there is a difference between statement and changes in working capital amount, your fund flow statement will not be tallied. Now, anybody has any doubt till now? Okay. So we'll move further. This is Home Limited cash flow statement. Now, what information they are given? Adjusted profit before tax is 1,10,000. Depreciation is 20,000. Building purchase is 1 lakh. Land sold so and so. Dividend is so and so. Share capital increased by this amount. So we'll find out working capital changes statement. Now, out of this, the debtors had changed by 15%, stock by 10%, creditor by 5%, and outstanding expenses by 3,000. So, considering the same, what I will find, my change in working capital. And after changing working capital is adjusted, I will calculate fund flow statement. Now, let's give me illustration in other way. Just a minute, please hold on. I'm getting some technical error. So illustration I will show in our next session for cash flow and fund flow. Now let's begin our next topic of first unit that is called as economic value statement. Now, anybody has idea what is economic value statement? Okay. Uh, if no idea, let me talk. Economic value added is nothing but it's like VAT, whatever the additional value I'm spending, that is I'm going to analyze with the expenses. If an operation of 10 rupees is done on raw material and I'm generating profit of 2 rupees, the percentage of operation is compared to the percentage of profits. And then I analyze whether the task performed is economic or it's simply an expensive. So economic value statement is beyond traditional profit matrix, where I'm going to analyze every activity of finance, whether it's a profitable, adding some value to my business, or I'm just making one product, second product, and third product. So in short, marginal profit earning is analyzed in economic value statement. Economic value statement, as I said, it measures corporate performance beyond accounting metrics. It tried to understand the performance or operational efficiency in a such a way that my every work is accounted towards goal of wealth maximization, towards goal of earning more and more revenue. Now, what is economic value statement? Economic value statement is a accounting statement where company is calculating shareholders value and appreciation in economic wealth by analyzing every accounting or non-accounting income and expenses with regards to their benefit or profit considerations. If already we have profit and loss, we already have cash flow and fund flow, then what is need of EVA? A traditional profit and loss method only shows difference between income and expenses, difference between profit, loss, results of profit and loss. But the hidden cost, like earning per share, or like destruction of assets, or like loss of goodwill, these are not considered in normal accounting statements. So normal accounting statements are mere value generations for profit or loss, but value appreciation in terms of my working capital or value appreciation in terms of my dividend to investors or to my goodwill is not analyzed by normal statement. So I required economic value statement. Secondly, economic value statement is mostly targeting wealth generation rather than accounting profits. Now, wealth generation means how much wealth is added to shareholders' value. So, in normal accounting statement, that is profit and loss, I'm just calculating how much profit I made, how much loss I have made, how much funds I received, how much funds I have spent. But in case of economic value statement, I will also calculate how much earning actually I'm doing. Because if I take a profit of 1 lakh rupees and out of 1 lakh, I'm paying taxes, I'm paying interest, I'm paying other charges, and hardly I'm getting 1,000 rupees. So 99,000 I'm just spending for unnecessary purpose. Then there is no wealth appreciation of investors or shareholders. Whereas out of 1 lakh profit, only I'm spending 10,000 and 90,000 are available for shareholders. Then it is adding to their economic growth, and that is a high appreciation in capital value. So wealth creation is analyzed in economic value statement rather than normal profits. Here, not only return on income, return on investment is more priority. Earning to each shareholder what is available after spending. So in account, we have normally theoretically gross profit and net profit. But in EVA, EPS and ROI, that is earning per share and return on investment, is more prioritized. Now, what is the formula for EVA? Economic value statement is equal to non-operating profit after tax. Now, why it is after tax? Because tax is the compulsory things which I need to do minus invested capital into weighted average cost of capital. Now, when I'm doing economic value statement, I have three things to calculate. One, net operating profit after tax or non-operating profit after tax. Now, in India, we call it net profit after tax, but its correct meaning is non-operating profit after tax. Why it said operating? Because it has admin part and it has also production, that is the P&L and trading account. Then out of this, I have to find out how much is capital, that is equity, debt, and lease. Lease means a longer term loan which is taken as an investment. So it is also added. Debt includes long term loans or borrowings. It can be debentures, it can be preference shares, or any form which I have considered as a part of capital. And equity means only equity shares which I consider. Now, in case of EVA, we always follow a WAC, that is weighted average cost of capital, because over the time the value of money is always declining. So time value of money is more valued in case of calculating the economic value. Now, if you remember trading account and profit and loss account, in both the accounts, we never consider time value of money. For us, it is only important how much profit is there, how much loss is there, how much dividend is declared, how much tax is paid. But if I'm getting money, what is its time value of money? It is accounted in EVA. Now let's talk about more in detail about components of EVA. Operating profit after tax means the profit which is available after operations are completed or after performing all the source and application investments applied to my income. So if my income is 1 lakh rupees and for generating income I required 50,000 to spend, it means my operating profit is 1 lakh minus expenses 50,000, it will be 50,000. Second, invested capital, it talks about equity, bonds, debentures, debt, and long-term lease which I am having. If suppose I have some short-term capital, in case of short-term capital, it is never recognized as part of my capital, because short-term loans are normally taken for only purpose of short-term investment or financing immediate requirement. Now, what are steps of EVA calculation? First, I need to find out what are the accounting distortions to get a true operating performance. Now, accounting distortions means I have to find out what is operational expenses and what is non-operational expenses. If suppose I have something non-operational income, for example, if I'm doing business of selling raw material like cloth, so my income should be by selling cloth and expenses should be for making cloth. But if I received commission for selling a property, if I received income by selling an car or building, that is not my business income. So non-business income, if I received, I have to minus from my profit. And if non-business expenses, for example, I purchase uh, machinery which is not of my business but for personal use, then drawing are the expenses which are not allowed. So these expenses again added to the expenses part and my profit is adjusted. So whatever the operating things they are considered, whatever the non-operating things like drawings, interest, free good sampling and so on. So these things are not considered the operating expenses. So if anything which is not operating, I need to adjust again the profit which I'm going to show. If any income is non-operating, reduce it. If any expense is non-operating, I need to add back. So reverse effect I need to give as a profit and loss adjustments. Once I find out net operating profit after tax, then I will find out what is my capital. I need to find out how much their withdrawals, how much addition is there, how much amount is added, and then I have to calculate weighted average cost of capital. And after weighted average cost of capital, I need to consider the formula which is shown, that operating profit after tax minus investment into working capital, sorry, weighted average cost of capital, it will give me economic value added. Now, why it is more important? Because it gives an idea of time value of money and it is a very comprehensive. Most of the non-profit metrics which ignored by traditional method are covered by economic value added. So it is most important. Now this is theoretical just illustration. So I'll wait for 2 minutes and then we'll proceed. Please read this. So we'll proceed for the next one. Let's talk about how to calculate EVA. Now this is a short example I'm taking because virtual I cannot solve the complete example. Net profit operating we have is 1 lakh. Invested capital we have one is 1 crore. Sorry, it is 10 lakh. So and our weighted average cost of capital is 12%. Now weighted average cost of capital I will cover it any other lecture. If you want it, just let me know in chat box if you want WACC also to be explained, because this already covered in the second semester, so I have not taken here. In traditional system, return on capital will be my investment 10 lakhs, I'm getting 1 lakh. So on 10 lakh investment, if I getting 1 lakh profit, it means 10% is my profit. So my earning is only 10%. But in case of economic value added statement, my net profit is 1 lakh. Whereas if I calculate weighted average cost of capital 12%, it gives 12% as 1 lakh 20,000. So actually, I have not earned anything. Instead of 1 lakh as a profit, it is showing 20,000 as loss because the time value of money which I invested is not generating an income. Now, if you just see, traditionally it is showing profit, but EVA it is showing loss. The simple reason is economic value or wealth creation is not given output as designed. So that's why when I say EVA, it talks about how much gain or loss I'm making. But in case of traditional, it only talks about the return gain. So getting mere profit will not show the good position. But if this profit is available to investors, yes or no, it will show great position. If I have profit of 1 lakh and if I have non-recurring cost burdens, which is resulting into loss to my investors, they're supposed to get 1 lakh 20,000, but they are getting 1 lakh. So it means in wealth creation, 20,000 is a short amount which investors are not getting. So I'm not adding a value to the accounts, but actually I'm making a loss. So this is an comparative statement which show why EVA is important to analyze cost of capital. Now, what are advantage of EVA? It gives a systematic measurement where I can make a decision for investment. So accounting profit can be shown position of my numbers of my assets, of turnover of my business, and so on. But EVA, it more illustrate wealth creation and wealth accumulation for my business. In short, EVA is a more broader concept which elaborate and understand how the things are analyzed and I'm generating the revenue in more appropriate manner. In normal method, that is a profit and loss, I'm just calculating the differentials between source and application of assets, but growth is only analyzed by economic value added because when I'm adding value to business, ultimately it's a foundation to earn more and more income in future. So if only profit is a significant, then it is very short-term approach towards considering my business. But when I calculate EVA, it is considered as a long-term approach because it's the base for future value generations. EVA is more oriented toward the shareholders. It is more oriented toward the understanding my investments are safe or not because profit will generate it. But out of profit generated, what part is available to shareholder that is calculated by EVA. So in EVA, we find out that if profit is 1 lakh generated from operations and I'm only available 10,000, then I'm having poor performance in managing my operational activity. So economic value statement is not giving emphasis on overall profitability. What it giving emphasis that whatever the operationals I'm doing, whether I'm able to generate any revenue or any addition to my wealth creation, because whatever the other like commission, incentives, sale of asset, purchase of building or sale of building, that is not my regular activity. And out of that, if I generate any revenue and I declare dividend, that's merely occasional. That means for 1 year, 2 year, or 3 year, it is not going to be continuous. But in case of economic value added statement, as per this statement, what is the operational efficiency I'm able to achieve? and I'm able to generate the revenue, that is for long term, because that is nothing but symptoms whether company is doing good or bad. So it is in shareholder alignment, giving clear accounting as a benchmark that whether I'm having sustainable growth or just merely I'm generating a profits which are not in accounted for long term. For example, there is a company called Satyam Limited where the person has two reserve. One is general reserve and capital reserve. From capital reserve, you cannot declare the dividend. But just to make the investor happy, Satyam companies start giving higher dividends. After some time, there was a liquidity crisis and company has huge borrowings. That results into very huge loss to the company. Now, in normal case, when I'm giving dividend, borrowing loan, this will not be disclosed because everybody happy, profits are getting, dividends are getting. But from inner side, I'm an unknown person where I will not understand whether the funds are from operations or funds are from adjustment. So when economic value added is analyzed of Satyam Computer, it is found that they have cheated the accounting concept that from capital reserve dividend is paid, and that cheating resulted into close of business and no Satyam is now anywhere. And that is one of the illustration that how EVA is more practical, more clear, and more useful to calculate sustainable growth and understand whether the business is actually profitable or it's merely numbers which I'm calculating for. So when I'm implementing EVA, it screen the project based on its ability to generate the income. It will not only understand the change in number, but it will also understand ability that this project, this contract, this production, this activity is generating more positive. Because if only output is generated, it will generate income, but that income is having corners of interest, borrowed money, then actually I'm not getting anything. So capital holding for any project is profitable or loss, whether it's underperforming or overperforming, whether it's adding value to my long-term valuation, it is always calculated by economic value statement. And that's why EVA is more profitable and considered for normal accounting policies and process. Now, what is drawbacks and limitations? EVA is very complex because here I need to calculate operating profits. In operating profit calculation, I need to analyze what is operating expenses and non-operating expenses. And there is no particular fixed formula which will give me what is operating and what is non-operating. It's merely on judgmental basis. Similarly, weighted average cost of capital, it can be of 2 years weighted, 3 years weighted, or simple. I need to understand what weightage I'm giving to it. Whereas the most important for any company, continuous research and development expenses are as part of long term. But in EVA, the research and development expenses, if not generating payoff, means if they are not giving results immediately one financial year, they are considered as loss. But actually, if I'm doing a research, it may require 1 year or 2 years. So beyond 1 year, if R&D activities are there and it has huge expenses, they are always called as a loss in economic value statement, which is not practical. Similarly, calculation of weighted average cost of capital and capital investment, it is a decision of board to decide what should be weightage. Now, many times there is a manipulation that how much weighted cost of capital should be calculated and how much weightage should be given to the each parameter. So again, giving weightage to the parameters is a challenging. Many times to show the good image of a company, manipulations and adjustments are done. So considering the technicality of EVA, its requirement, it is always prepared by heavy manufacturing industries. It is always prepared by the large companies having large capital structure and where decisions are based on technical methods, and capital investment. But when it's a small company or when a company going with merger acquisition or heavy R&D or it's a fresh startup having very less physical assets, less manpower, it is always not welcome. Maximizing economic value added is always an improved situation which shows operational excellence and smart capital management. But when it comes to small business, it's always a challenge. It helps for my boosting profitability and pricing strategy. It helps to make my operational efficiency more better, helps to generate maximum capital outcomes, reduce inventory, and generate and find out overperform, underperform assets, as well as it will give me to maintain my financial flexibility. So overall, if I want to increase EVA, I need to concentrate on operational efficiency, working capital management, inventory improvement, investment on overperforming and avoid underperforming, and manage my debts. So if I do this, I can increase my EVA. So in conclusion, I can say EVA is the best tool to understand wealth creation and economic value statement, concentrating beyond just profits, and I can understood whether my business is going to sustain long-term profitability or just I'm calculating profits. So it's a comprehensive tool to analyze profitability, whether it's actual or it's only a mere time seeking. So that's all. Today, we discuss about fund flow, cash flow. I illustrated a small example of fund flow, cash flow, and we talk about economic value statement. Now, this is the end of our first unit of advanced financial management. We need to solve numericals on EVA and cash flow and fund flow as a part of syllabus. So we'll conduct one session offline, and there we can just take a practice on the same. So that's all for the today. Thank you for joining session. We'll continue tomorrow morning for new session, that is a capital structure theories. So you can now leave the meetings and join the next session. Thank you.